Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. The Australian dollar recovered near the 61.70 mark on Monday, and from that snapping a 6-day losing streak after the upbeat Chinese economic data provided some support. While on Friday, the Federal Reserve's preferred inflation gauge, the PCE price index, met forecasts with the annual inflation easing to 2.5% in January from 2.6% in December, with the core PCE falling to 2.6 from 2.9%, while both indexes rose 0.3% month over month. Along with that, the Federal Reserve's inflation target remains at 2%. Meanwhile, escalating tariff threats have lifted the greenback but raised concerns over the economic impact. After last Thursday, President Trump confirmed 25% tariffs on Canada and Mexican imports from the 4th of March, with additional 10% duty on Chinese goods and potentially 25% tariffs on EU shipments. Looking ahead though, crucial US data this week, mainly the non-farm payrolls and the ISM Manufacturing and Services Index, will be closely watched for insights in the US economic growth, while labour market strength and inflation trends. Along with these reports, we also have the Federal Reserve Chairman Powell's speech, which could shape market expectations on monetary policy. While in Australia, the focus shifts to retail sales and the GDP. So with the technicals, we can still see that the ADX is holding to a bear trend and the market is somewhat oversold. As we get closer towards this level of 61.70, I feel the market might snap or rebound and find a bullish pattern unfolding. But we do need to clear this 60-day simple moving average, and if so, a break above the level somewhere around 62.50-70 could reinstate the upside and look back towards 64 to 65 cents. With the euro recently breaking down, the market is still attempting to recover. And there is a little bit of divergence here, but nevertheless, I still like to see a break above the level of 104.35, which could inspire a little bit more to the bullish case and look on towards 104.70 to 105.40, and with the key support level seen at 102.75. But again, well, the market just couldn't take out that level of 148.70. And from the bounce, there's a bit of a squeeze coming back into play, but still a little bit nervous as it gets closer to that 150.80 to 151.35 level. I do feel, though, opportunity may strike again if we contest this region, as the bears will probably come in greater numbers and eventually see the market down towards the bottom side of this range, 148.70. Now, a break beneath there could give further scope down towards the region of 144, or even eventually on a broader scale of 140. I am quite bearish on dollar yen, and I feel it's about time we do see a correction. Looking to sterling, the market's still holding above this key support level, somewhere around the region of 125.65. And viewing the inverse end shoulders, I still hold the call while the trend's intact. That is up towards 129 and reassess. Turning to commodities, the precious yellow metal was mixed after closing the week and the month on a down tone, and therefore could see further weakness, but I feel the opportunity will come back as safe haven is still the flavour. And nevertheless, any weaker play towards 2,856 may see a bounce. With the broader call, I still believe the market can eventually get towards the region, somewhere around $3,000 for 2025, and finding this current weakness soon to be reversed. Having broken down, oil still holding above this $67 a barrel, and I feel the market is showing a bit of divergence here, especially for the MACD. Could see a bounce back towards the region of 71 to maybe $73 a barrel. So the support level still likely to be somewhere around that 67 mark. Well, that's a wrap. Thank you for joining me, and as always, look out for the intraday report, and I hope you enjoy the great start to the new week.